Good afternoon and welcome to our webinar. My name is Selim Yazıcı and I'm representing Turkish Institutional Investment Managers Association, which is the co-host of this event together with Turkish Capital Markets Association and EFAMA, European Fund and Asset Management Association. We planned the event to be around 100 minutes and I will try to be your moderator all this time. We have a pretty long name today, Post-Pandemic Issues of Homo Socialis, a healthy, respectful, and long life with financial assets. What I like most about this title, of course, is that it starts with the phrase post-pandemic. It makes me think for a moment that we are already there. I think we are seeing the light at the end of the tunnel, so it's a good time to start talking about it as well. Today we will have two keynote speakers who will be focusing on two financial concepts of the post-pandemic world. These are how money and identity are changing, and also environmental, social, and governance factors that are reshaping our investments. I think we learned the meaning of Homo Socialis a bit more over the last 12 months, although the concept has been in place for some time. We have been helpless against the disease, against which the only method to fight against was cooperation on every level of the society, which included countries as well. We learned that caring for others, especially the elderly, was not only a humanistic approach, but also it was necessary for a healthy, sustainable economy. We learned keeping ourselves in a safe and good condition was not enough for a happy, long life, and that we also needed healthy, happy people around us. No need to remind you on this International Women's Day that gender equality can also be easily regarded within this concept. I believe 2020 was a year where the change, which was already being led by the millennials, have accelerated, and we are witnessing history being made. Today, we will try to focus on the financial and investment aspects of this change and try to understand how it's already impacting and it will impact our lives in the future. But before we start, let me give the floor to a very experienced local leader in capital markets, Mr. Tevfik Eraslan, Chairman of Capital Markets Association of Turkey. Tevfik Bey, buyurun. Tevfik Bey, we cannot hear you for the moment.
Sorry. Teşekkür ederim Selim Bey. Good afternoon, dear colleagues and guests. I would like to welcome you all to our first webinar, jointly hosted by Turkish Institutional Investment Manager Association with the participation of the European Fund and Asset Management Association. This event marks our first collaboration of this kind, as sole self-regulatory organization in the Turkish capital markets, representing all institutions of the industry. We are happy to cooperate with local and global stakeholders. I would like to thank both Dr. Didri and Mr. Yazıcı on this occasion. Let me start by noting that our gathering is taking place on a special date, the International Women's Day. I would like to use this opportunity to emphasize the importance of women's social, economic, cultural, and political achievements around the world. Women's Day is also a call to action for accelerating gender parity. It is important to acknowledge that increasing women's participation in economic life is not just contributing to economic growth by simply adding more people to the workplace, but also studies show that closing gender inequality at the work boosts productivity by bringing greater gender diversity. Hence, lowering gender inequality is believed to contribute to welfare of all. Although women's participation in our industry is significantly higher compared to other sectors of the Turkish economy, we still have a long way to go to achieve equality. Today, we are going to discuss post-pandemic issues affecting our industry with our distinguished guest. During the social distancing measures implemented to slow the spread of the COVID-19 pandemic outbreak, digital technologies have made it possible to stay connected with social life and to remain active in professional life globally. This trend has also had many repercussions in the financial industry, such as accelerating the transition to cashlessness and the development of the central bank digital currencies. Moreover, the COVID-19 crisis is not just a health crisis, it has shown how a sustainability crisis can impact economies and the societies. This experience led to an increased awareness among the leaders about systematic risk. At the same time, in the capital markets, the pandemic has increased the concentration on environmental, social, and the corporate governance considerations. Our valuable guest speakers will share with you today their thoughts around those two themes. I would like to introduce our first panelist, Mr. David Birch, author, advisor, and commentator on digital financial services. His book, Before Babylon, Beyond Bitcoin, From Money That We Understand to Money That Understand Us, published in 2019, covered the history of the money and payments, provided a vision about how technological developments will continue to transform money and payment technologies. In his latest book, The Currency, Cold War, Cash and Cryptography, Hash Rates and Hegemony, published in May last year, he further elaborates the issues around the digital money. Mr. Birch will discuss new instruments, new markets in the post-pandemic era. Dr. Dietrich, Global Head of Regulatory Intelligence at UBS Asset Management, will then take over the floor to discuss the rising importance of ECG for the asset management sector in Europe. With her extensive expertise in the financial industry as a regulation and strategy expert, I would like to extend my gratitude in advance to our keynote speakers for their participation and valuable insights, and hope that findings of today's webinar will be beneficial for all participants' understanding of current market developments. Now, let me give the floor to Selim Bey.
Yeah, I think we can, as introduced by Tevfik Bey, we can directly start to listen to Mr. Birch.
Well, hello everybody, and thank you so much for inviting me today to come and address you. Greetings from London. You know, I'd much rather be in Istanbul in person, one of my very favourite cities, and I hope that in the not too distant future I'll be able to come and visit you in person again. But we all understand that we have to do the best we can in the virtual world at the moment. So I hope the presentation I've put together for you and this video, I hope it is effective at communicating some of my ideas and also why it is I think that the future in the capital markets might be very different from what people are thinking right now. So what I'm going to do is I'm going to explain to you some observations from how things have changed during the pandemic. And then I'm going to try and put a couple of those observations together to try to make a very interesting vision of those post-pandemic future markets. But instead of just making crazy predictions and saying these things are going to happen, I hope that you'll see that my argument builds up. So anyway, let's give it a try in the virtual world. Okay, so new instruments and new markets. Let me talk you through this and show you why I think this is going to be the case. Where are we? Right. So that's me. I know a little bit about technology, and particularly technology in financial services. And I spend a lot of time thinking about digital money and digital identity, as you will see in a moment. I've written a few books on the topic, and if you'd like to, look into what I think about these things in a bit more detail, please do feel free to read and learn more. We've called this talk the post-pandemic financial services world, but of course it isn't really the post-pandemic world. As I say here, the pandemic, it wasn't a black swan, as they say. The occurrence of global pandemics was number one, certainly in the British government's risk register for a decade. I mean, they didn't do anything about it, but it was number one in the risk register. And the same is true for many companies, I'm sure. So we're not looking at a world where the pandemic goes away and then everything goes back to where it was before. We're looking at a world where pandemics occur from time to time. It's a globalized world. We travel a lot. People move around. These things will happen again. We've seen SARS and MERS, and obviously the countries that had to deal with SARS have done a lot better at dealing with coronavirus than we did. So we're going to learn from the pandemic, and it's going to change. We're not going to go back. We're now living in a new world where this happens from time to time. So we have to think what's going to be different in that world from our point of view. And I mean structurally. I don't mean superficial. I don't mean like, are we going to work from home or not? I'm talking about sort of the structure of markets. So what I've done is I've divided. So I thought we'd have a quick discussion of some of the different aspects of what's happened during the pandemic to try and build up this view of the future. And I've divided them into sort of two groups, two sets of building blocks for this next generation of financial markets. So we're going to spend a few minutes talking about the digital money side of things, and then we're going to spend a few minutes talking about the digital identity side of things. And then we're going to put those together to try and make some intelligent, I wouldn't say guesses, but some intelligent projections about what that might do in markets. So if we very quickly start with talking about digital money, the pandemic has accelerated the transition to cashlessness, and at the same time brought in some new technologies to people that weren't really using them before. And it's prioritized the need for strategy in this space. So let's just look at a few. I mean, I won't spend a lot of time on this because I'm sure you guys know all of this. I mean, I remember working on contactless payments in Turkey 12, 15 years ago. I don't even remember, a long time ago. So you guys know all about this stuff. But the pandemic has accelerated the transition to cashlessness. That means we now need a strategy, because if we just allow cashlessness to happen, I mean, people often point to Sweden as the example to learn from in this case. If we just allow cashlessness to happen, then some people are marginalized and excluded, and we have suboptimal outcomes. So we need a strategy to migrate towards cashlessness with, universal access, so that everybody in society can benefit from the transition. As we think about going cashlessness, we're also thinking about not so much going contactless as going contact free. People have got used to this, throughout the pandemic. People who never used QR codes before use QR codes for everything. We have Bluetooth and NFC and all these kind of things. But we don't even want to tap on things. So people are very happy to use QR codes. The improvement in phone cameras means that codes can be scanned more accurately. You had people like Apple making it automatic when you scan it and so on. So I think this is going to be, I don't think people are going to go back to the old way of doing things. People wouldn't have done this, but because of the pandemic, they had to. And now they've discovered actually it's easy just to scan things and move on from there. So I think that's a permanent kind of change. And it's going to be everywhere. So what we'll see is a convergence of transactions into largely that mobile environment. So it won't matter whether you're on the web, on the phone, you're in a shop, you're talking to somebody. To execute a transaction, you'll do it the same way. You'll instruct it, you'll authorize on the phone, strong authorization with biometrics. Even in shops, we'll go in that direction. And I'm speaking to you today. Amazon has just opened the first contact-free shop in London. I mean, they've been in America for some time. I went to the one in San Francisco. I can't even remember when I went there, 2019 maybe, I don't remember. But actually today, Amazon have just opened their first contactless shop in London, where you just walk in, pick up what you want and walk out, basically. So I think that's here and people will get used to transacting in that environment. I think so. I don't think that's controversial. Now, one thing that has come up during the pandemic, which has made us think again, actually, is the issue of stimulus. When something bad happens, how do you get support to people? In America, they did it in a very traditional fashion by printing out checks and putting them in the post and sending them to people, which is you know, all very nice and quaint, but I'm not sure it gets the money to the right people as quickly as possible. It's interesting to me that in developing markets, the mobile wallet became the channel. I've used the example of Colombia here, but basically getting cash to people who needed it, the way to do it was through the new channels. And so people who never had mobile wallets before now have to have them in order to get government stimulus. And then that kind of reinforces the trend away from cash towards cashlessness. So you see it's kind of reinforcing there and moving forward. And I think a lot of governments have looked at this. I mean, we'll come back to this in a minute, but I think a lot of governments have looked at this and decided this is a better way forward. So there's something going on there as well, which reinforces the transition to cashlessness. So what are we going to replace cash with? Well, we're going to replace it with some kind of digital currency. And I think it's important to understand the distinction between digital money, which is what we have now, which lives in bank accounts, and digital cash, which can live anywhere in wallets. You know, if I send you digital money, it goes from my bank account to your bank account. It goes from my bank account to the merchant's bank account. If I send you digital cash, it goes from my wallet to your wallet. It doesn't go through the banking system. It doesn't go through SWIFT. It just goes from my wallet to your wallet. And that's a very important change. So because those wallets can live in my car, in my hat, in my watch, you know, in my phone. I mean, it can be anywhere. And actually, I don't want to get into this today, but of course, those wallets don't have to belong to people because they can also belong to bots and artificial intelligences and things and so on. So just the important distinction here about digital money to digital cash. And for digital currency, we need digital cash because it has to go person to person. So how do we do that? Well, we could do it using cryptocurrency. We could just forget the whole system, just forget about banks and SWIFT and everything else, and we can all just use Bitcoin. If you want me to talk about Bitcoin and or if you want me to tell you whether to buy Bitcoin or not, I haven't the faintest idea whether you should buy Bitcoin or not. I have absolutely no idea. And we're not really talking about that today anyway. So we could use the technologies of cryptocurrency, and we could use them to issue central bank digital currencies. And this has already started to happen in China, which is by far the most advanced case. Madame Lagarde said that she thought there might be a digital euro within 4 years. The person who runs the ATM networks here in the UK has said it could be 2 years' time and there'll be an electronic sterling. In the US, people are talking about trying to create a digital dollar. And I don't think people have really thought through the implications of these digital currencies, because if everybody can just have digital dollars in their wallets and do all their business in digital dollars, you know, there's probably 180 currencies around the world that will just vanish because everyone will just use dollars. So the implication, I don't want to get into it today, it's not the point of today's talk, but the implications of digital currency are quite significant. But anyway, my point here is that we can see the pressure for some kind of digital cash and some kind of central bank digital currency. So that's what the pandemic has made us think, and that's what the pressures are in terms of money. So you can see what I'm thinking about digital money. The pandemic has accelerated the transition to cashlessness. At the same time, we have these new technologies available to us to create digital cash as a replacement. It could work in lots of different ways. One of the ways it will work will be central bank digital currencies. But this idea of value flowing directly from a wallet to another wallet, from a purse to another purse, from a thing to another thing, without going through the banking system and clearing and settlement is the important point. The pressure for that is important to my argument. Okay, so now we've thought about digital money. So now let's take some time to think about digital identity. The pandemic has also made us look at some new, or has pressured us to do something about digital identity, which has been a big problem in this transition from an offline to an online, always on, always connected economy. As I'm sure many of you will understand, the absence of interoperable digital identity infrastructures has been a real friction and has really held things back. But the pandemic has pressurized us into doing something about that as well, I think. So let's have a quick look at what I think about that. So, so a very simple level, because of open banking and APIs and pressure to open up around the world, we see this here of what's called data-driven liquidity. In other words, it's the data associated with payments and bank accounts and transactions which becomes more important than the transactions themselves. And although it's not the subject of today's discussion, I just want to flag up there is a big tension there between the current financial services infrastructure, or the institutions in that infrastructure, banks and insurance companies and credit card companies and so on, and big tech. Because if big tech can use those APIs to get access to that data, then big tech has that data plus its own data. And that's not a very level playing field for the banks to compete on. So I don't want to talk about it today, but this opening up, brings out this flood of data. But of course, it interrelates with digital identity, because you have to make sure you're granting access to the right person and the right account and all these kind of things. So that pressure is pressure for some kind of digital identity work in the financial services sector, and that connects with pressure that comes from outside the sector, because obviously one of the impacts of the pandemic has been to drive people online who weren't online before to do transactions that they didn't do before. So in America you have the phenomenon of the Robin Hoodies, the people sitting around at home with stimulus checks and nothing to do, who are suddenly trading for the first time, and you've seen the kind of the impacts of that on the instability of some of those markets and the emergence of new phenomena around the coordination of that sort of trading. So from the financial markets perspective, we need to work to protect people. That's why I call it smart safety, not just telling people, oh, don't give your password to people and always use 2FA. I'm not just telling people that, but sort of just making it part of the fabric. And this is one of the ways that financial institutions can stay part, even if big tech takes over the data side of things, or it makes strides in that. One way for regulated financial institutions to stay in that loop is to be the guardians and custodians of people's identity and their attributes. And so there's lots of reasons, both internal and external pressures, why the sector needs some action in digital identity. And I'd always thought, up until the pandemic, in fact, I've given a talk about this in Istanbul before, I'd always thought that the banks would be the people that came together to provide this kind of more flexible digital identity infrastructure platform to everybody else in society, including governments, actually. But something happened during the pandemic which sort of made me change my mind on that. First of all, the lack of digital identity turned out to be a real problem for a lot of people during the pandemic. But now we have pressure coming from other areas, because we all want to start traveling again. We all want businesses to open up again. So suddenly you see this idea of test certificates and vaccination passports that need to be stored in wallets, phones and things and carried around. So whereas digital identity before, I was kind of imagining it as something that banks would provide, and they'd make money by providing good service in that area, and people would carry around their bank identity. Now we see other kinds of identities in that space, because we see them coming from the travel industry, retail, restaurants, and so on. And that's added to the pressure. And I think that's not quite sure how that's going to pan out, but it's very interesting to me, I have to say. So during the pandemic, we've had to onboard people digitally, not just for banking, but for everything else as well, health, education, all sorts of other things, people who were never onboarded digitally before. That means we've had to spend a lot of money and invest heavily in digital onboarding, and there's lots of good companies in that space that have that provide a terrific service. And so in some ways, this problem started to sort of go away a bit now, because these companies have got so good at onboarding people by showing passports and driving licenses and whatever. Now we can onboard people pretty well, I think. This is the FATF guidelines for digital onboarding for financial institutions, but it doesn't matter. Digital onboarding of companies has been more difficult, and certainly in the UK, it's been a source of colossal fraud with respect to pandemic support, business loans for the pandemic, and so on. And because you don't know whether the company is real or not, you don't know whether the person is really an officer of the company or not. Because of the strange way that company registration works in the UK, you don't even know if the person who's an executive officer of the company is actually a person or not. You don't even know that. So it's no surprise that this has caused huge fraud. But what that means is we now know what the costs of not having digital identity infrastructure in place are, and so that's accelerated the desire to do something about it. The UK has just announced it's going to look towards a sort of framework version of digital identity, kind of what they have in Australia and New Zealand, Canada, places like that, rather than a sort of centralized government route to digital identity. And there's lots of reasons why I actually think that's a better way forward. But my point is that that framework has to apply to not just people, it has to apply to companies. And of course, because of what I'm going to say about the future of money and everything, it's got to apply to things as well. So the pressures for digital money have the pressures for digital identity have grown. Some parts of it, the companies have started to solve some of those problems. Other parts, we need coordination and action. In a way, it's interesting enough to me, because I'm interested in those things, to look for new opportunities in the world of digital cash and digital currency and cryptocurrencies and what can be done there. And it's also interesting to look for new opportunities by doing something about digital identity, onboarding people, finding ways to deliver security and privacy into that always-on online environment. I mean, both of those things are interesting by themselves. But when you put them together, I think you see a very new kind of financial market emerging. And I'll explain to you why I think that's the case. So this is all about what are we going to do when we put those two things together. So what's the narrative for that? Well, I'd like to suggest the thing that brings together digital money and digital identity is what I'm going to label smart money for the moment. And there are two parts to smart money. I've used Facebook's, what was called Libra, what is now called Diem. I'm using their private digital currency as the example here. But you can see there's two parts to that. There are two institutional bindings that turn this from some bits into an actual market. So on the one hand, we have, so at the underlying layer, the technological layer, we can now move bits from one place to another securely. So we can do the value transfer. Well, but so what? We have an institutional binding that links those values that are being transferred to things in the real world. So if I tell you that those bits are worth $10, or if Bitcoin tells you those bits are worth $10, it's up to you whether you believe me or not. If I tell you these bits are an ounce of gold, these bits are an airline ticket, these bits are, whatever, it's up to you to believe that. But if one of the banks tells you that, a regulated financial institution says these bits are $10, or these bits are an ounce of gold, or these bits are a barrel of oil, or these bits are a square inch of the Mona Lisa, or these bits are, a ticket for Disneyland. I mean, whatever it is, if if a regulated financial institution tells you that, then you can believe that, and that then becomes a market. So there's a binding from those bits to something that turn it into a crypto asset, and those crypto assets are stored in wallets. And if we combine those wallets to things in the real world, people, for example, or companies. So if I tell you wallet 123456 is Dave Birch, again, it's up to you whether you believe me or not. But if the bank says, or the market says, you know, or the regulator says this wallet is Dave Birch, then you can believe it's Dave Birch, and that turns it from just a crypto market into a real world market, where people will really want to manage assets and trade. So we have this idea now of this smart money that's moved around from wallet to wallet, and it's bound to things that are in the real world. So, and this is the world of in my book a couple of years ago, I said, this is the world of the IBM dollar, building on the work of Edward de Bono from many years ago. So, and the idea there is, if I want to sell you IBM shares, then we have, you know, market makers and broker dealers and delivery and payment and settlement and all sorts of intermediaries and complications and so on. But if I want to transfer IBM money to you, it's instant. It just goes from my wallet to your wallet. And that's why people that I regard as serious, you know, financial markets people, that's why they're interested in this, not because of their ideological commitment to decentralized trading but because it's cheaper. I mean, basically it's I can send my money to you. Now, a way of implementing that is using, as I'm sure you're all aware, shared ledger technologies of one form or another, blockchains, if you want to call them that, even though most of these things aren't blockchains. And this is the world of tokens, ICOs and tokens, which at the moment seems very chaotic and full of criminals and fraud and all these sort of things, which it undoubtedly is. But this idea of smart money, these tokens, you know, that are moved from wallet to wallet without any clearing and settlement, using this underlying digital value platform that can be trusted. So I've used the example here to show contracts that are written in Solidity that run on the Ethereum platform. You've got the underlying, you know, digital value that's maintained by the Ethereum platform, and then you've got the binding that says, you know, these tokens are, you know, whatever, by whoever puts them onto the platform, and these wallets belong to whoever. So for example, in the you know, very simple example, you can imagine a system where, you know, somebody says these tokens are you know, units of electricity that you can use in the future or something like that, and then you trade them on this platform, and then at some point you trade them for the actual electricity that you want, a guaranteed rate, you know. So there are different kinds, I mean, as I'm sure you've all been through before, there are different kinds of these tokens. You know, people tend to divide them into these three blocks of securities, utility, and money. I'm not much interested. That's not the point of what we're talking about today. So I'm just going to wrap them up and call them all tokens, and I'm sure you'll understand what I mean. And I've used here, I mean, I've used the definition that FINMA, the Swiss regulator, put together for this. They were the first jurisdiction to regulate these kinds of tokens, and I think it's probably, you know, a good enough definition as any other. So we have our tokens of one form or another, and we're storing them in wallets and trading them around. And because of the underlying digital money technologies and because of the digital identity technologies, we can now do this in confidence. We now have regulated markets, which are quite unlike the markets that we have now. There is nobody in the middle. There is no central body or central database or whatever. These are markets that are maintained essentially algorithmically. And I've written a few times about why I think that these markets are so important and why people will gradually begin to shift certain kinds of trading into these kinds of these kinds of decentralized token markets, because they provide a better platform for some kinds of trading. And I mean, I haven't done the argument justice there, but I hope you can see why I think this. You put together the digital money technologies and the digital identity technologies, what you actually get is a new kind of market with new kinds of financial instruments in it. So those are some articles by me in Forbes, but it's very important that you don't listen to me. I'm come from the tech side of things. I'm just, I'm making these crazy predictions about the future. You shouldn't listen to me. But here are some people that you should listen to. So Jonathan Larson, who I have immense respect for, who has a long track record of looking into the future on these kind of technology things. I interviewed him on stage at Money 2020 Asia 2019, and he said, this is his quote, he said, tokenization is really a massive trend, a much bigger story than cryptocurrencies, ICOs, and even blockchain. And I think he's right, but you should listen to him, not listen to me. The bigger long-term structural change is in the market itself and how that market works. And then a couple of months, towards the end of last year, Jay Clayton, when he was still chairman of the SEC, said in October, it may very well be the case that these all become tokenized. So in other words, it isn't just that certain kinds of trading move over, but actually everything becomes tokenized because it's a cheaper way of running these markets. Now, but remember, these are markets that operate in a decentralized manner. Now that brings problems and opportunities with it, because it brings certain kinds of transparency and accountability. But obviously the privacy and security have got to be managed properly, and they've also got to be properly regulated. And that, I think, is going to be an interesting problem. And the reason for that is because the financial instruments that grow up in those markets, and you can see this now, if you go and look at the trading that's already going on in tokens, if you want to experiment with those platforms, Uniswap or something like that, if you look at the trading that's already going on there, it's largely trading that's being done by bots rather than people, and it allows the construction of quite complex financial instruments, because you're locking up some collateral to loan in this currency, and then you're trading it over for those kinds of tokens, which you're then lending to somebody else. And the packaging up of those in quite complex instruments is, it's much too complicated for me to understand. But I suspect it's also much too complicated for most people to understand, because it's not a market for people. It's a market for bots. What we're creating is a new market to deliver lower cost financial intermediation to the end users, e.g. me, through an entirely different set of traders and institutions and these decentralized markets. Markets in which the traders and the regulators are all bots and AIs, and can do things that we can't really imagine nowadays. So this is why I think, you go from those kind of tokens. So I've got a token here that's a barrel of oil. That token goes onto a digital asset platform. It becomes part of a very complex financial instrument, not the simple packaging up of dud loans that we had last time around. Those instruments are traded around between bots and inside these new markets. So I'm sure that sounds like crazy science fiction talk to you, but I hope you can also see why I think the evolution of digital money and digital identity takes us in that direction. So I hope I've given you something interesting to think about there. Maybe it sounds a little bit crazy to you, creating these markets for AIs to trade instruments that we don't even understand, but I hope I've shown you why I think the pandemic has accelerated us towards that world, I hope I've given you something interesting to think about today. And I look forward to coming and presenting to you again in person very soon. Thank you for listening.
David, thank you very much for the very visionary and mind-opening speech. Of course, these subjects can take a long time. We can talk for hours, maybe, but I think this was the best we could get in a half an hour time. I think we will have some questions from the audience. So
Please.
let me try to convey this to you with a little pinch of my comments, maybe. I'm not going to ask you about the value of Bitcoin. No worries about that. But of course, something which is always asked to us, and it came again, what drives the value of digital currencies? Is it only supply and demand? Because people generally compare it with gold and say that it is not much different in that sense. But when you look at gold, it's been in use for thousands of years, and generally its value is much higher in the less educated, let's say, less financially and digitally literate masses of people. I think same is valid for digital currencies in terms of less digitally literate people, among less digitally literate people.
Well, I think we have to distinguish. People are using the word digital currencies to mean many different things. They're using it to mean both cryptocurrencies whose value might be speculative, digital asset tokens whose value might be underpinned by gold or oil or some other things. Or digital versions of fiat currencies, which are essentially debt. And I think I personally don't see a future where one or other of those wins out. I see a future where people will have access to more and more different kinds of currencies for their portfolio. So you say, at the beginning, perhaps some people would prefer to choose a digital currency which is based on gold, for example. I mean, in a way, I'm surprised that hasn't already become more of a thing. But as I tried to make the point in my speech, in the longer term, I don't think personal sentiments about these things will play the role they play now. Remember, Keynes very famously spoke about animal spirits. You know, the markets are controlled by animal spirits. But in the future, bots and artificial intelligences, they won't have those animal spirits. So they will construct portfolios, you know, purely on returns and risk calculations and balances. So to say what is the value based on, some of the value is based on real things, but to be honest, most of the value now is based on pure speculation. In the future, I don't think that will be true.
Thank you very much. There we have another question about something you mentioned, wallet-to-wallet transactions.
Mm-hmm.
You say that transactions will be made from wallet to wallet and will not be done via traditional banking, clearing, and settlement systems in the future. Do you see any conflicts here? That's the question, actually. What will happen if there's a problem, let's say a big cyber attack, and who will provide the necessary guarantees to the people?
Well, let me break that question into two parts, Salim, because I think there are sort of two separate issues there that are bound together. So one is, should future digital currency systems, should they be based on the existing banking system or should they be separate from it? And my feeling, of course, is they should be separate from it because I want the ecological strength of having the two different systems. If one goes down for some reason, then we can use the other. If the credit card network goes down, I can still buy things at the store using my electronic wallet and so on. So I want them to be separate systems. I think there's there's a strength argument to that. Now, as for who would underwrite the system that allows person-to-person transfers offline, well, I don't think that's as complicated as it sounds at first, because I think I made clear in the presentation, I don't think either the central banks or third parties will be the people that put this in the hands. It will be regulated financial institutions that put this in the hands of people. So although I will be able to send money from my wallet to your wallet without going through the banks, I got the wallet from a bank and you got your wallet from a bank or from a regulated institution. And they will be required to underwrite the security associated with those wallets. I don't think that's as big a barrier as it sounds. We have 10 years of experience now showing us that things like Bitcoin can be secure in an environment where they're attacked every single day by hackers. And I think we can use some of those technologies, although you saw my sympathies are with tamper-resistant hardware. I much prefer solutions that are based on some hardware. But nonetheless, I think the levels of security that we would need to allow offline transfers up to a reasonable limit, perhaps, I don't know, $1,000 or something like that. I think the security is adequate for that already. So I don't think it's a barrier, to be honest.
Yeah. I think there's another question, but which might be similar in that sense. We have a question about digital identity. You told us about smart safety, and some people might think that people will be more under the control or under the monitoring of these entities you just mentioned, like it could be governments, central banks, or companies who provide these smart solutions. In that sense, I mean, we already have a lot of discussions around social media companies these days and their power on data and everything. From a personal freedom point of view, are we going to be in a better or worse situation? What would you predict in that sense?
Well, that's actually a very good question, I think. For people like me, I think the downsides of having currencies that allow complete anonymity. So at first that sounds good to people. We should be able to send money to each other without the government knowing. And I can see that argument, but the downsides to that, what it opens up in terms of crime and corruption and money laundering and terrorism, it's just unacceptable I think in a modern society. What we should demand from the infrastructure is privacy, not anonymity. So what we should say is people must be entitled to appropriate legal levels of privacy using these kinds of money. We live in democratic societies. We vote for governments that make the privacy laws, and we should all abide by those privacy laws. Money shouldn't be separate or special from that. And in practice, that means that the transactions themselves might well be anonymous, but the wallets won't be. And I can't see any circumstances in which any government, Turkish or British or Swiss, would allow people to have unlimited access to anonymous wallets. I don't believe that will happen. Now, if the wallets aren't going to be anonymous, in order to do that cost effectively, efficiently, in order to reduce the overall cost of financial intermediation, we have to have an effective digital identity infrastructure. And that's unfortunately where the UK is a little weak at the moment. We don't have that in place, as some other countries do. I would prefer not to have a centrally government-controlled digital identity, because I think it might be hard to reach the sort of privacy goals that we want with that. But nonetheless, I'm sure we can find some sort of compromise where the bank gives me the wallet, the bank knows who I am. If that wallet is involved in some kind of criminal activity, then the police or the government can go to the courts and ask for the bank to disclose who that wallet belongs to using normal legal procedures. So it's a terrific question. I think the solution lies in effective privacy regulation, and I cannot see any realistic possibility of any government allowing anonymous. I just don't see it.
Yeah, I also believe the new world needs a lot of new regulations, and
Absolutely.
we're not there yet in this technology. Maybe one final question for you. We have another keynote speaker right after you who will talk about sustainability issues, and there's a lot of discussion about these cryptocurrencies that they are not carbon friendly, like they are creating a lot of carbon footprint. They are sometimes comparing it to countries like New Zealand and Holland. Do you think this can be used as a factor by like crypto skeptics or digital currency skeptics or some governments and central banks to heavily regulate this, and then we will not go to where we want to go? And
well, I have to say this is slightly outside my field of expertise, which is why I'm so interested to hear what Sabine has to say. But my feeling is I'm not sure if the sustainability or otherwise makes much difference in the longer term. And that's because, for example, suppose the use of Bitcoin becomes so great that all of the world's energy is being used up for Bitcoin. Well, no government is going to let that happen. I mean, we can't have all of the energy in the world being so there must be a limit on it somewhere. And I can certainly see a situation. You see it in Mongolia right now, where the Chinese government is banning Bitcoin mining in certain areas because it's using up all the electricity. But you could see a situation where you say, well, look, in Iceland, for example, all of the Bitcoin mining in Iceland is produced using geothermal energy, and that's perfectly acceptable. Why not? And in fact, Bitcoin provides a rather interesting way for Iceland to export that geothermal energy out from the country in the form of Bitcoin. So I can imagine a situation where governments will say you're only allowed to use renewable energy, or you must use a certain amount of renewable energy to do this. So I don't think it's a barrier, but I'm not an expert in that field.
Perfect. Very interesting indeed. David, thank you very much.
No, thank you for inviting me, Salim. It's a real
we hope we can see you again in Istanbul. I know you've been here before, but hope we can do that again. So thank you very much.
I look forward to it. You're welcome.
So let's move on to our next guest. Let me give you a brief introduction about Dr. Sabine Dietrich. She is the Global Head of Regulatory Intelligence at UBS Asset Management. She's a senior legal, compliance, and public policy professional in financial services with global expertise. Currently, Sabine assumes responsibility for public policy and governmental affairs, as well as legal assessment of key and new and existing regulations for UBS Asset Management in EMEA, Americas, and APAC, with delivery to the Asset Management and Executive Committee. Prior to her current role, she was, amongst others, head of EU public policy for UBS Group. She's a qualified German lawyer by education and worked before joining UBS for many years in Freshfields, Bruckhaus, Derringer. Sabine holds numerous industry positions. In particular, she represents UBS Asset Management in the board of Brussels-based Industry Association, EFAMA, also our co-host today, and Executive Committee of AMIC, the Asset Management branch of the International Capital Market Association. She lived and worked in Frankfurt, Milan, Paris, Zurich, and London, and she is the author of a number of publications, holds a PhD in International Securities Law and an MBA in HEC Paris, in combination with STA Bocconi Milan. So a lot of titles. So it's good to have you here today with us, Sabine. So let me give the floor to you with your presentation. Then we might take a couple of questions from the audience as well.
Sure, Sabine. Please let me know if something doesn't go the way it should go. Do you see the presentation?
Yes, I can see it.
Great. Yeah, so I'm really honored to be able to speak today to you here, and in particular because it's about a topic that I'm very passionate about, That's very close to my heart. So sustainable investing. And indeed, it's not only close to my heart, but it's something that the world can no longer ignore and does not longer ignore. The difference maybe is they don't call it, or we don't call it sustainable investing really any longer. Everyone talks about ESG. And ESG stands for environmental, social, and governance. So environmental is addressing many aspects of climate change. So how to mitigate the risk from climate change, how to adapt your business model to climate change, but also around maintaining biodiversity, preventing pollution, and a couple of other goals in the environmental sphere. Social relates to social relationships in the environment of a company, some particular labor relationships, but also investing into communities, equality, inclusiveness, etc. And governance finally is around good corporate governance. So the relationship, executive management to other employees, the executive pay, the way you control this governance. Now, today, everyone talks about environmental, basically, but that has not always been the case. So the UK, for example, has been very strong over many years on the governance side, and including these criteria in investment decision. And some Scandinavian countries were very much focused on the social side. Environmental really came in around 2015, and there were a couple of triggers that made it so prominent, also in our financial services firm. And it's really around the climate change that got to the forefront of public discussions. And around this climate change and preventing climate change, three things happened by the end of 2015. First of all, you had the UN agreeing to 17 sustainability goals. Goal number 13 is around climate action, but around 6 others are relating to environmental issues. And then at the same time, you had the conclusion of the Paris Climate Agreement, where around 200 nations are committing to reduce temperature rise to 2 degrees. And to actually aim for a temperature rise of only 1.5 degrees. These two sort of political elements, to achieve them, it was clear you need financing, and you need financing also from the private sector. And that's where sustainable finance really started to come in. The third element that we also saw comes from the Financial Stability Board. So they started looking, so this group of central banks based in Switzerland, they started looking into the potential risk to financial stability of environmental change, climate change. They established by the end of 2015 a task force that had to work or volunteer to work on recommendations around climate-related financial disclosures. And these disclosure sets, they were addressed not only to the financial world, but also to non-financial companies, so across all industry sectors. And they aimed at, by publishing data and disclosures, to enable a more informed investment decision into companies, taking ESG risk into account and allowing strategic planning around it. So these 3 elements really triggered a hype nearly from 2015 around environmental. And it got another accelerator, of course, last year with the pandemic starting. And while the pandemic as a health crisis, of course, brought also the social element and to some degree the governance element back into the mind of people, I think it's acknowledged that the pandemic is also a consequence of environmental change and humans intruding basically into wildlife. And looking into how economies can recover, politicians set up recovery plans. And if you look into the EU, they've said, we want this recovery to be sustainable. And so in addition to that development over the past 5 years until last year of, channeling private funds into climate change protection, you now had also like a massive stimulus committed by the EU, for example, to bring in public funding. So this is like the entire political environment and societal environment, I would say, in which sustainable finance really got to force. In parallel to this development, of course, the industry players came in from 2015, roughly, more and more, and looked into this ESG piece as an innovation piece. And UBS, for example, was also one of them. We started there and developed in our view, very excellent offering, of course, around ESG. But what the industry players did was everyone kind of defined a bit themselves what is green and what do I consider risk, how do I label it, etc. So while there had been developing of an industry understanding, it was not clearly defined. At the same time, client demand started surging, in particular on the institutional side, in particular here by investors with a long-term horizon, investment horizon, such as pension funds. This basically was then the environment into which regulators stepped in. And tried to deliver this framework around sustainable finance, or ESG. And I mentioned here in these slides like a number 730 related policy revisions. You can find other data which suggests it's like 2,000 publications around regulation globally related to ESG. So it's a massive wave of regulation that we see coming up. And of course, I will focus here a bit on Europe, in particular on the European Union. And I think when you look into regulation by the European Union, you can probably say there have been 3 waves. The last one just starting basically. The first wave was about defining the basis, the framework really. The second one was enabling compliance with these basics. So the experience that the industry started gaining around, how to deliver these basic regulatory requirements. What do we need actually to really make it happen? And not only compliance, but really to make this a success, to achieve the goals that the politicians and regulators had to channel these private funds into the green economy. And then the final touches is like, what still needs to be added to make it properly work, and the international angle also to it. So if you look into the first wave, which is, the one most people are at the moment in our industry, you're looking into in very, very, very detail. So after this Paris Agreement and after ratification in 2016, the European Commission had set up a high-level expert group looking into developing an action plan around sustainable finance, and that was then published in 2018. There are a number of initiatives here that are captured by this first sustainable finance action plan, but the 3 most important ones, the ones that gave the basic and the framework, are taxonomy, risk integration, and disclosure. So taxonomy really is about defining what is green, so that everyone has the same understanding, both from the product manufacturer side, so an asset manager, and from the investor side. And this is really then around greenwashing and actually fostering the trust into the product offering around green products for investors. Risk integration is, not only, to understand the risk of what your investment and your performance could have when investing into a company. So how could climate change actually impact your investments, basically, from that perspective? But it really is an angle also, not only of risk management, but of course also of ensuring performance, and hence make it an attractive product option ultimately for investors to invest in. And disclosure is around educating investors, triggering that additional hype, I would say, so that more and more demand is even there on the green side. So these were the three main developments. There had been like other publications around, green benchmarks and a number of green bonds on industry standards part, but these are the three main elements. Now, when you started looking into these three main elements, it became clear that without data, you can't do anything. And so the second wave, really, one element they focused on was providing this information, financial information and non-financial information. And I've listed here a number of initiatives, again, from the EU side. So EFRAG and Non-Financial Reporting Directive. I've mentioned before the TCFD, so this task force from the Financial Stability Board, and what many are now looking into, not only in the EU, but like literally globally, is to make these voluntary recommendations from 2017 mandatory, actually. And so it's all about coming up with the data that allows you to assess the taxonomy, and then also to properly process the risk and integrate the risk. The other element for the second wave addressed the demand side again. So there are investors, who now already ask, to invest in green products, but green products in a sense that's publicly defined, basically. And I guess with the disclosure requirements and taxonomy still waiting for the final implementation, they turned to other labels, basically. So they just want to be sure that what they get is indeed green. And so this discussion around eco-labels started, green bond standards continued, but also around rating providers. So again, just investors want to be sure that what is sold to them as green is indeed green. And this is like kind of complementing the puzzle, basically, here in this respect. Now, when we go to the third wave, what is basically left, it probably, so starting probably from now on, or Q2 2021, the second quarter, it probably still is around making the taxonomy work. And so part of the taxonomy is already defined, and I'll come to the details in a bit. But other parts are left, including on social and governance, and a number of other environmental objectives. So that still needs work and more definition. At the same time, with more and more industry players trying to apply the taxonomy, it's also a goal to re-question maybe some of these agreed parts of the taxonomy, and indeed just come up with a holistic part of the taxonomy altogether. And the other side around, next to taxonomy is really our industry is global. Financial markets should not know borders, basically, and it's particularly important if you want to make ESG a success, because you invest not only in EU companies, but in APAC companies, and you sell your products from the US into other countries, or from the EU into APAC, and so on and so on. So you need this sort of borderless understanding around ESG. And so let me go a bit more into the details of the main building blocks of what is ESG from a regulatory perspective. And I think it's so important to get it right, really, because what everyone is expecting is that the demand side will really develop from, at the moment, primarily non-ESG products, or maybe only risk integration products, to like dark green products or light green products, so to the green and ESG product side. So in order to satisfy that demand as well, you just need to get it right, and you need to make it in a not only right, but like make it in a convincing way, basically, and present your offering to investors. So the kind of piece of regulation that's closest to us at the moment is the Sustainable Finance Disclosure Regulation. And indeed, part of it enters into force in 2 days' time, so it's extremely timely to actually talk about it. And some of the more detailed regulations have just been defined last month and published. And so they will phase in probably around beginning of 2022. But what this kind of disclosure regulation does is it obliges fund companies, asset managers, advisors, portfolio managers to disclose their way of dealing with sustainable finance and ESG, both on an entity level as well as on a product level. And there are different places where you need to disclose this, including in all prospectuses of your fund. So it's an immense kind of undertaking. The other element that comes from this regulation, this Sustainable Finance Disclosure Regulation, is actually a categorization of products. So, I start here like with Article 6A and Article 6B, but ultimately, so it's not so much about the ESG is not taken into account at all. It's about you have this product where ESG is integrated, the risk is integrated, but then you have the sort of proper green products, which we call Article 8, Article 9 products. So the ones which promote environmental or social characteristics, or even stronger, have it as an objective to contribute basically to it, so the proper impact investing here. And it will be very interesting to see over the next 5 years, or until 2030, like how really this product range of our industry is shifting towards Article 8, Article 9 products. One element that always was a big concern for the industry on how to make it work, how to really live it, was the adverse impact. So it's not only about the risk of the impact of environmental and social risk on the performance of your portfolio, but it's we also need to take into account, at least the big asset managers, the big firms, the adverse impact. So how is your investment actually impacting environmental and social factors? And it's a pretty complicated set of how you would get along here with it. So this had been a big part of the discussion in the industry. The taxonomy is one of the next things that we need to closer look into, and it kind of phases in from 2022 over a couple of more years, basically. It looks into activities and links them to how they take into account certain sustainability objectives. And taxonomy has defined 6 objectives, namely climate mitigation and adaptation, So that's the focus of the current technical standards as well around the taxonomy. But it has a number, like 4 other objectives that are also part of the taxonomy. You see it here, like marine resources, circular economy, biodiversity, pollution prevention. And it links all of these activities of different industry sectors towards, is that activity contributing substantially, at least to one of the sustainable objectives? And does it not do significant harm as a second step to the other sustainable objectives? And then it has a minimum social safeguards that it needs to meet as well. And it's a very, very detailed mapping per activity of what an activity needs to be in order to contribute substantially or in order to not do significant harm to other sustainable objectives. It's a big book basically of rules that the industry needs to deal here with. The taxonomy is something, as I said, that should prevent greenwashing. But it's also, of course, linked to a set of other sustainability regulations. So, for example, so it's a benchmark tool. So it's linked to, for example, green bond. It's directly linked here to the taxonomy, and it's linked to a couple of other green products and definitions around green products. So it's a centerpiece, really, about understanding of what is green or not green. And maybe just to look a little bit, outside of the European Union, what we see is that other countries are now also stepping in and think about what kind of taxonomy should they come up with. And very often the discussion starts with, should we simply follow the EU taxonomy? But then the challenge is that these other regions, such as in APEC, but also some European countries outside of the EU, what they have is that maybe their regulatory framework is different to the one of the EU. So the taxonomy is like referencing, of course, to numerous EU regulation, that if you are a firm outside of the EU, you cannot just follow these references. Or like in this country that thinks about its own taxonomy, simply the understanding really of what is green is different. So we had even like in the European Union a huge discussion around how to treat nuclear energy. Is it green or is it not green? And sometimes also simply your economy in the region is just very different, and you need to accommodate these differences. So that's a discussion that we see, in Singapore, for example, but it's a discussion that you might also see, on the UK side and Swiss side in the near future. Risk integration, that's relatively high level dealt with in the EU regulations. So it basically means that you need to integrate sustainability risk and principal adverse impact, like into your entire organization, in the investment process and in the second line of defense, so the risk management process and compliance process. It needs to be part of your DNA, really. So it needs to be everywhere in the way you do business and how you deal with your products. But it doesn't necessarily say in all details of how you do that. So again, taking a step aside into other countries outside of the European Union, in Singapore and Hong Kong, they also looked into this risk integration piece. And they came up with some suggestions around scenario analysis and modeling to assess the risk rate. This is not what we have seen so far in the European Union. But what it makes is it does make the link between product manufacturers, so fund companies, asset managers, and distributors, so the banks. So banks need to look for their investors into what is suitable and what is appropriate, and is the product good for the market it targets. So a lot of terminology we have from other pieces of regulation in the European Union. And of course, we as product manufacturers, we need to serve this basically for the banks. So there's a lot of like alignment happening between manufacturers and distributors that is absolutely key for making a success. Now, this is a map that I have set up here on where you see outside of the European Union regulation coming up. And indeed, to start with the EU, you always had like some countries front running in certain areas or focusing in parallel to EU regulation around sustainability. I mentioned before, Scandinavian countries. France was, one of the first countries looking into green finance, really, so having this environmental focus. And there are bits and pieces where, the European Union is not yet looking into, but some countries are still coming up with additions to this European framework. The UK has signaled it will not automatically, at least, follow the European Union after Brexit, so from January this year, but that it will look into how and whether indeed to deviate from what the EU is doing. Switzerland, so our headquarter country, as you know, is also not part of the European Economic Area, and hence it started just this year as well, with some pre-discussions over the past years. But has started a more detailed discussion around where should we start with our taxonomy, how close should we be to the EU taxonomy or around disclosure. And for Switzerland, just because it's embedded by EU countries and EEA countries, the element of alignment is always like a relatively strong alignment to EU regulation. So it is a very interesting discussion that we have at the moment, whether and how, again, we could deviate in certain areas from EU regulation, while at the same time, hopefully maintaining market access to the EU. And then I mentioned Hong Kong and Singapore already, around focusing around risk integration piece, Singapore also on the taxonomy side. Taiwan has looked into disclosure requirements, and China has a taxonomy for their green bonds. That is actually now something that they are discussing in a so-called international platform for sustainable finance with the EU to develop a common ground taxonomy. And all of the discussions that you have, globally around taxonomy, outside of EU and China, of course, is feeding into this goal of indeed having a common ground taxonomy globally. So something where everyone is aligned and understands what is green. And then I have the United States here, and at the moment they're still sort of beige and not that much green on this map. But of course, with the new Biden administration already announcing to rejoin the Paris Agreement, everyone is expecting the US now to step into this space as well and think about regulation that supports the sustainable finance industry. So this is this is a sort of little bit of whirlwind of what we see around the regulatory space on ESG. So I mean, I mentioned it in the beginning. I'm very passionate about the topic, but of course, in general, our firm is very passionate about ESG, and we see this as a big source of development and further innovation. We are lucky enough to be embedded in a group, so we work with our wealth management, investment banking division, and we do have a number of additional touch points with sustainability, which I haven't mentioned so far. But of course, one other angle of sustainability is In the philanthropy space, so EBS has EBS in society. So it's about not so much this, risk and performance-related sustainable finance. It's about more the giving, basically, for the good to others, or social investing even. And then another element, of course, that's very important is it's not going to be only the funding from private and public sector into the green economy that might make the difference, really. You can also, by engaging with companies as you are the investor and the stakeholder and the shareholder, you actually can make a difference also in the way that companies look into their business model and the way they have their governance and the way they engage on environmental issues. So this active engagement is the core part of also what we do. And I guess that's from my side.
These issues are, of course, I can't say they are new to Turkey, but they are actually in an accelerating way. They are coming to our agenda. And as Institutional Investor Managers Association, we are trying to lead in that sense. We are trying to increase the awareness, especially among financial market players. So we have a couple of questions for you as well after this really good and detailed presentation. And let me ask you the first one. We understand that the global pandemic, as you also mentioned actually, has certainly gave a boost to the efforts of making the world a more sustainable place, because a year ago, before the pandemic, we were still having to deal with climate change skeptics, and US was in a different mood, and now we are seeing that USA is coming back to the Paris agreement. And personally, I'm observing a rising credibility for scientists especially. So the question is, do you expect an acceleration globally in ESG compliance, and how will this affect the global markets? Which part of the developed world is likely to lead in ESG in the next 10 years?
Yeah, so I think you mentioned, two very important developments. And let me start with the US. So the fact that we have a new administration that is committed to the Paris Agreement will, as I mentioned as well, likely lead to regulation that is favoring sustainable finance as well from the US side. And I do think it's so important, not only because this is an additional push to a probably already quite strong sustainable finance industry in the US as well, but an additional push. But it's really also so important because if you want to have this harmonized global understanding about sustainability and taxonomy, it just is incredibly helpful to have the US on your side and come up with a global framework around things. I mean, many of these global institutions, international organizations such as IOSCO in Madrid, where the US is a member, and many other countries, of course, many European countries and so on, are members. If these organizations can properly start to develop this common understanding, it will be opening doors further for sustainability. The other element, the pandemic. So I have talked a lot about sustainable finance, but of course, ultimately, if you want to invest into green economy, it's a little bit the question around the hen and the egg, basically, which was earlier there. You need more green companies. You need a green economy in other industry sectors. And channeling funds into defined already existing green economy, of course, will trigger that other companies try to follow in that green space and transition into greener business models and so on. The additional push that was necessary or possible now during the pandemic, just think about the aviation industry, the change we have seen here would have never happened without the pandemic. It's sort of like too detrimental to economies, if you want. And so the direct change on some of these other industry sectors for a pandemic recovery into sustainability, as the EU also wants it, is in that sense, of course, a chance nearly to foster further sustainable finance as well.
Thank you very much. We have another question which might be more related to Turkey and maybe in bigger sense, the emerging markets. Turkey is a country that has to finance a significant amount of current account deficit. So what kind of duties are ahead of us, assuming that we will continue to finance this via borrowings and portfolio investments, mainly from the developed markets, which are rapidly becoming ESG compliant. So what will Turkey and maybe some other emerging markets have to face unless they can comply timely with the new standards?
Yeah, so I'm not an investment professional, so I can't really speak too much about the specific position of Turkey here. But coming from the regulatory space, I see two elements that are important here. The first one is, I mentioned the importance of data coming from companies, so financial and non-financial data. So the TCFD part, and again, the non-financial reporting obligations that are in the making, or accounting standards that we see in the ESG space. Ultimately, of course, there is a risk mid to long term that companies who cannot deliver this sort of data and information, they will be at a disadvantage for sustainable investing products. And that's again like something why it's so important not to look in a closed way only on Europe, but to really look into international collaboration and to make it work globally, really. So a Luxembourg fund, for example, can invest into companies in APAC or South American emerging markets. And in order then, however, to maintain that green labeling that you might want to have for that fund, you need the data from the companies so that you can assess the risk, that you can do the disclosure, and that you can map it against the taxonomy. So taking all countries on board and not being isolated in one region is absolutely important. The other element is that was a big discussion again when the taxonomy was developed, and it still is a discussion. How do you deal with transition companies? So companies that are not yet green as per taxonomy, no matter whether it is the EU taxonomy or another taxonomy. So they probably are brown, but they want to transition into green. How can you support them to transition into green? And how can you ensure that they are not excluded also from financing streams during that transition time, so that they have an incentive really to become green? So this element about how to deal with transition companies, it's a big discussion point, and it's my understanding that it's currently also discussed in this European Sustainable Platform that is looking into the current definitions on the taxonomy, and then adding the still missing parts of the taxonomy. So it's my understanding they look again into this transition part as well, at least to discuss it. And you see it in other regions. So, for example, in Singapore, when they are discussing the taxonomy, they explicitly now ask the industry, should they have actually 3 categories, like a traffic light kind of system, with a transition economy, basically, as well, that can profit from that journey and that sustainable finance. And these are very important discussions to have, to not, leave behind countries, industry sectors, and to allow them to transform, basically.
Thank you. Of course, we always approach from a financial point of view, but apparently it might have a big impact on global trade as well, going forward. And the last question, although you said that you're not an investment professional, maybe your academic side can answer this question. Is there any empirical evidence that ESG investing is not only good for the world, but also brings better returns than traditional investments? And how can someone start to invest in such financial products? Do we already have in place the new generation of research, the new generation of analysts and portfolio managers who can provide these services to the people who actually want to invest?
Like on the research side, to start with, it is something that's in transition. You have, of course, many companies, including in UBS. We have invested into ESG-related research, and the regulation just gives us an additional push, really, to kind of further develop that. But it is something, again, that regulators are looking into. I mentioned the rating element to it. So how do rating agencies actually rate from an ESG perspective companies? And of course, that's very important then as well, how research can be set up. And whether you can invest into ESG products, of course you can. It was always an industry-led innovation. So what regulation is now doing is just to harmonize the understanding. It's giving it an additional framework around it. And as I mentioned, the disclosure regulation will enter into force in 2 days' time. So you will see the first products that you can buy having this disclosure already around ESG risk and how ESG criteria is integrated into the organization. And it will rapidly increase with other compliance dates now coming in over the next year and 2, 3, 4, 5 more years in Europe, but then also in other regions globally. And if you just can remind me, like, the first part of your question, and then I can answer that as well.
Is there any empirical evidence that ESG investing is returning better in the long term as compared to brown investments, let's say?
Yeah. So again, I'm not an investment professional, but I think the entire concept of ESG, of sustainable finance, of course, is that on the long term, if you invest in the green economy, the performance will be better. So if you look from a long-term horizon, it's supposed to be ultimately better. Simply because if climate change continues in the way it does, many of the maybe more brown economy parts will actually struggle to continue with their business model. So one element around sustainable finance is to invest not only in something that's green, but that's forward-looking and is adapting to the changes around climate change. And I think we have last year, we've looked into performance of ESG products, and they did perform very well compared to non-ESG products. But I think particularly when you look into this long-term horizon side, the concept is that because you take better into account ESG risk, that ultimately the performance will also be better. So it's one element around how you actually look into potential performance of your investments. It's just taking that risk into account and having a forward-looking, innovative business model that you can invest in.
Perfect. Thank you very much, Zabine, for being part of this. It's good to see that we are observing that in Turkey, we are having more and more ESG compliant products, especially on the investment funds side. Hopefully the number will increase exponentially in the coming years. So thank you for a very good presentation and talking us about especially where Europe is going in that sense. And we are of course in Turkey inspired a lot by European regulation. Thank you very much. So I think we are now at the end of this event. This was a co-host event by Turkish Institutional Investment Managers Association, Turkish Capital Markets Association, and European Fund and Asset Management Association. So we thank all these institutions a lot for their support, and we also thank the audience for staying with us and being part of it. We'll see you next time in another event. Thank you very much.